Just an introduction on our main man, Will. So I think what's interesting about Will is that he's decided very early in his career, building this wealth management firm, to focus on purely SaaS sales. And in fact, I did a lot of research before I decided to work with Will. There isn't anybody else in the UK dedicated just to SaaS sales leaders and salespeople. So it's a huge, huge opportunity. And at this point, he's worked with hundreds of salespeople and sales leaders on working on their plans for wealth management into their future, planning for savings, pensions, and investments. So can we have a big round of applause for Will Rees? He's our first speaker.
The importance of having access to people that can help you get to that next earnings level, whether it's the 150, 200, that's the secondary point tonight. What we're going to show you is the support structures in place to help you whatever stage you're at. Thank you. So, as James said, I'm going to be talking a bit about a case study. It's anonymized, of course, but it's a very, very common one. And I'm hoping the objective of my session is for you to be better aware of what your opportunities are at a given earnings level. So this is the case study. Okay. Let's take a sales leader. It could be IC as well. Typical comp plan. You've got a basic salary of 100, OT of another 100, total earnings of 200. The first point I'm going to focus on. After tax, you're taking home approximately 116k. How are we feeling? Laughs tell it. Oh, okay, good. I think a point here to say is that I'm not against tax, right? I agree with taxation, but my entire business is on being efficient and paying as little as possible. So what I'm going to show you today is how you can make some better decisions to potentially reduce that number. Because if you pay less, you keep more. And that's what we're trying to achieve. Let's assume you've got total expenses of 6k per month or 72 grand a year. It's a case study. I've just got to chuck some numbers out there. What we're going to try and show you is what you could do, right? It doesn't matter if you earn 200. This is what you could do with savings. So hopefully relevant. These are sort of three common areas that we talk about. Now, the top one, everybody in here has thought about it at this point in time. Interest rates are better. Just put it in cash. You can get 5%, guaranteed, no risk. Well, inflation's a risk, and I'm sure you'd agree that inflation in the last 2 years has been higher than 5%. So there's an inflation rate risk. Pay down the mortgage. I totally get it. Nobody likes a big mortgage. Rates are 5%. Products coming for a renewal. Got to get rid of it. I get it. The last thing that people want to do is pay more into a pension at this point in time. Interest rates are higher. Mortgage is more expensive. I can get better in cash. Like, trust me, I have this conversation 25 times a week, as you can probably tell. But don't let this be a blocker. Because yes, retirement is far away for many of you. But trust me, it comes up thick and fast. Clients tell us all the time they wish they did more sooner. So how does it work? For this year, if you earn, let's just use some really simple numbers, 260 and below, you have a 60k pension allowance. Now please, I'm caveating a lot of stuff here. There's a lot of technicals with what we do. There's a little bit more to it than that. But for the basis of this example, it's 60k. You've paid 10k into your company pension scheme. You've got 50k remaining, you've got 44 in saving. Let's just take less than half, right? Because we don't want to commit all our money longer term. Let's put 20 in. This is how it works. And I'm very happy to send these slides as a follow-up as well. If you pay into a personal pension, company pension as an example, you immediately reclaim basic rate tax relief. That's just a pension rule. Don't overthink it. Often people go, oh, why is that? It's just a rule, right? Let's not go down that rabbit hole. So you immediately save 5,000. That's 5,000 pounds in tax that you've paid this year. So instantly you're 5 grand better off. It's a good start. You're a 45% taxpayer in this example. 200 is over the 125k threshold. For those of you that are there, you'll know about it when you look at your pay stumps. When you do your self-assessment, please don't forget this point. You're owed an additional 25%. There's some horrifying statistics that are out there about people that forget to claim additional tax relief. They're probably not salespeople, let's be honest, but you are owed an additional 25%. So in high-level figures, you've committed 20k to your pension. You've reclaimed 5 automatically. You can claim another 6,250. It's 11,250 guaranteed within these rules before any investment growth. So instead of losing 84k in tax, you've lost 11,250 less. Can't do the maths in my head, but you get it. Why does this exist? If you tell a salesperson, some of them are in the room, did you know if you pay a bit more into your pension, you save 45% tax? Most people go, I don't believe you. It's a fun little game. The problem is that it's become overly complicated. People just don't want to look at it. You join a company, let's think of a life as IC or leader. You join a company, instantly you want to hit the ground running. If you're a leader, you want to add value to your team. You want to understand the territories. You want to understand the targets. How was last year? If you're an IC, you want to get stuck into your PG, hopefully. But let's say in the unlikely event you did look at your pension, it's ridiculously complicated because of years of regulation. You go, nah, don't want to do it. Fair enough. The typical comp plan of a salesperson, anybody in the room know what their pension contribution is? You'd be in the small percentage that do, is often a small percentage of your basic. So James and I have talked about helping you get to that next level. If you're an IC on 100K basic and you earn 500, your pension contributions are likely on that 100K percentage. So it doesn't matter what you take home, you're not saving anymore. So it's a personal responsibility, right? And the sooner we realize this, the sooner we can make better decisions. Again, as I say, you're not going to earn 200, 300, 400 grand a year for the rest of your life and only save 10 grand a year to retirement. You're never retiring. Lack of savings, the impact, we're all in sales, the cost of inaction. Why should you do anything? If you do not commit more to your future, you will have to work longer or retire with less income. Now, I don't know a salesperson or a sales leader alive that's quite happy to do this job into their 70s. Again, the response tells us everything, right? Most people come to us and they say, I need a get out of sales plan. I don't want a retirement plan, I want a get out. You laugh. Why have you chosen to do it? You've done it for the rewards. But often we find that people that don't focus on the planning have the financial rewards, but short term. Less pension equals more tax. It gets better. Of course it does. Pension allowances can go back 3 years. So let's talk about how this can work in practice. This is getting a little bit more technical, but I think it's relevant. As a salesperson, you are never going to have consistently good years. Within reason, you get the idea, the fluctuation, the irregularity of your income. That can work to your advantage. So basic example, you've earned 150, 170, 200, 200 in the last 4 tax years. It's a pretty sensible growth plan, I'm sure you'd agree. But that 200 could have been 500. We all have those years. You've built your accounts, you've done your planning, eventually the big deals happen. You can go back 3 tax years and use your unused pension allowance. Now, I've done this for a few clients, and again, they still don't believe me, but you're getting a 30 grand tax rebate, a 26 grand tax rebate. How many people have done a self-assessment and had a 3, 4, 5 grand tax bill and gone, more? Really? By paying into a pension, not only can you offset that, but you can get tax back as well. Again, it's a little bit more technical, but I'm happy to go through that for anyone that's interested. I think it's always important when you do any presentation, particularly with what we do, because it goes very technical very quickly, to have some reflections, think about your own situation. Pension is a no-brainer for retirement, but is there something else you're saving for that has to be considered? Because pension is an absolute commitment to retirement by the nature of the product. What's your plan? When do you want to retire? If it's prior to 58, consider when are you going to get your income? Because you can't access your pension before 58. Again, for different people, different ages, but generally 58. And are you on track for your retirement objectives? Most people, when I ask them that, go, I don't know what my retirement objectives are. Probably not a good place to start. Let's have the conversation. And just to wrap up, a nice little summary that most leaders tell us they did wish they'd met someone like myself. It doesn't have to be me, clearly. I'd like to think it would be, but most people do tell us they wish they did more earlier. And hopefully with what James and I are building, we give you a platform to, if you choose, have this sort of advice earlier in your career and make better decisions. That's me. Thank you for listening.